And we are live. Welcome to this edition of Tax Tips Tuesday. Say that 3 times fast. I love this. I am so excited about our collaborations, our mastermind. I believe that a rising tide raises all boats, but only when your boat's in the water. So I thank all of you, whether you're joining us live or you are watching the replay. I really honor all of you for having your boat in the water today. This is really one of those conversations that a lot of people shy away from. But really, when it comes to really gaining wealth, creating generational wealth, building a legacy, it really requires us to turn towards our money and understand and not overspending in areas like our taxes, right? We don't mind paying our fair share of taxes. We just don't want to overpay our fair share of taxes. So my name is Leah Garcia, financial strategist and insurance professional. And really, truly, what I do is I specialize with entrepreneurs and small business owners with up to 50,000 employees who want to build their legacy and create generational wealth. Folks, if we are opening up a business and we're getting up early, we're staying up late, we're working nights, working weekends, missing birthday parties, and when it comes time for us to leave our business, we just close our doors. In my humble opinion, we just bought ourselves a job for those 10, 20, 30 years. To really create something that's a legacy and create generational wealth, it requires us to start playing chess. We have to understand the rules of the game, and we're playing the money game. So this collaboration is about helping you as that entrepreneur, that enterprise with up to 50,000 employees, learn how to start playing the money game. And because we know at the end of the day, it's not how much money we make, but it's how much money we keep that matters most. And I am so excited for this collaboration. My collaboration with her is just really transformational because I talk to my clients about strategies. It's not just about getting an insurance policy, it's strategically getting an insurance policy. What is that going to do for you long term? And so many times tax professionals kind of miss it. They don't understand that it takes the team to really collaborate to put those strategies together. And she truly gets it. She really has a heart. She really loves talking about taxes. She says it's a treasure chest, which I just love that. And so please give it up for my esteemed colleague, my special guest speaker, and I just adore her, Miss Chris Carty, enrolled agent. Please take it away.
Hey everyone out there, I'm Christiane Carty. I'm a transformational tax advisor. What does that mean? It means I help entrepreneurs transform their tax issues, your tax liability, into opportunities for creating wealth. And I do that by creating strategic plans that are curated especially to your tax situation, your financial situation, and your wealth goals. So I literally quarterback your financial team and make sure that all the pieces of your financial team are working together to give you that one result that you want, which is to create lasting wealth. So today I am honored to be here with Leah. And as you heard from Leah, she is also a financial strategist that helps business owners, especially on the insurance side. And today we would like to discuss with you guys something that is truly foundational to your tax strategy, and that is your entity type. So one of the things that business owners really get confused about is choosing an entity type for your business and how does that impact your business. So many people are into I need tax savings and I need tax strategies. I need this. I heard about this strategy on social media and I think it's perfect for me. But tax strategy really begins from the foundation, and your foundation is your entity type. Which entity type you choose determines your tax implications, right? How your revenue is going to be taxed. So I've seen so many business owners who are in business and they're doing business as a sole proprietor or they're doing business as an LLC. And there is such a huge difference between being a sole prop, being an LLC, being an S corp, being a C corp, right? There's different implications to each one. So I tell most people, if you take anything away from this, is that there is rarely ever a time that you should be doing business as a sole proprietor. Because if you're doing business as a sole proprietor, it means that you never have any liability protection. That what do I mean by that? I mean that if you're doing business as yourself, so let's say Christiane Cardi owns Christiane Cardi, the business. It means that if the business gets sued, all my personal assets are involved in that lawsuit. So there is no separation of liability from my personal asset or the business asset. That's number one. So let's say, for example, you're a truck driver. You're hauling cargo long distance, right? So you own one truck, and that truck is in your name. You're a sole prop. You're running this business, but you're traveling cross country every day. You get into an accident. You damage property, maybe more. What that means now is it's not just the truck or the money in the business, in the bank account from the work that you did with the truck that's in that lawsuit. It means that all your assets, which means that if you have if you own personal property, your home, all your assets are a party to that lawsuit. There is no protection. So there's no protection, there's no tax savings. So why would you do business as a sole prop? That's number one. Then the next thing is LLC. So everyone is, I have an LLC. So let me just tell you guys something. I'm gonna burst someone's bubble. An LLC is all well and good, it's nice, but an LLC doesn't save you any money on taxes. The only thing an LLC does is an LLC gives you liability protection. So you one step up from that sole prop. It means that if you manage the LLC in the way that it's supposed to be managed, if you keep the records that you're supposed to keep, if you don't commingle funds, then if your business is party to a lawsuit, your personal assets are protected. And that's it. There is no tax savings in an LLC because you're still being taxed self-employment pay. You're still paying self-employment taxes. You're paying taxes on your self-employment taxes, and then you're paying on your profits. You're paying taxes again on your tax returns. So there is no tax benefits to an LLC. However, you have liability protection. So another thing with LLCs is that the commingling funds. So a lot of people, a lot of business owners I own an LLC, but my LLC has one bank account, and I dip into that bank account all the time. I pay for my personal stuff with the bank, with that bank account. There is no separation. So legally, you're supposed to have some separation, but you don't because you're commingling funds. What happens when you commingle funds is if you are party to an audit, if you get audited, you're in trouble. Because when IRS does the examination and they can't determine which expenses are for personal or for business, all your expenses are now lumped into being personal. And so you're going to lose all your expenses, all your deductions. So having an LLC gives you some level of liability protection, but there's some things that you have to look out for to ensure that you are not breaking the corporate veil. That's what it is called. When you're commingling funds, when you're not following the rules, it's called breaking the corporate veil. So if you're not breaking the corporate veil, you have liability protection. If you are, there's no protection for you.
And you know what? You said a lot. Let's kind of unpack some of this because this is such good stuff. I love it. I love it. I love it. Let's kind of rewind a little bit because this is something I hear all the time, especially with contractors, painters, roofers, electricians, plumbers, general contractors. That's one of the first questions I ask them when I start to work with them. What's your entity type? What's your business selection? And they look at me and they kind of go, I'm a DBA or I'm a sole prop. But it doesn't matter. It's just me. I just have a few 1099 people that work for me, right? And so this is one of the objections that I get to creating something other than being a sole proprietor. I say, you know what? It's okay. I'm not worried about the corporate veil because about piercing the corporate veil or creating a corporate veil because I've got an umbrella policy. So I've got my liability. I've got, an umbrella policy. So if something happens, they're going to take care of that. I'm not worried about it. My personal assets are completely okay.
Yeah, no, that's not.
So what would you say to somebody that says that?
That's not how it works. I mean, okay, yes, you have insurance, but your insurance covers you for certain losses, and that's great. But it doesn't cover you when it comes to anything to do with an audit. So how does you have an insurance correlates to your corporate veil? Breaking the corporate veil is an IRS thing. It's an audit thing, right? And it is also, yes, a liability thing. Your insurance may cover you, but that does not mean you're not liable. So I guess it's in that sense, I would say it is a personal, is the way that you look at things. So if I'm paying an insurance policy, I don't want to have claims against my policy. It's great if something happens and I have an insurance policy that may be able to cover me. But why would I disregard the rules that I need to keep just because I have an insurance policy? And
Yeah.
you're the insurance expert, right? So what happens when I file a claim against my insurance policy? What's the effect? What's the impact of that on that policy, the cost of that policy in the future?
Yeah, the impact is now you've had a claim. So probably your rates are going to increase. They might even just, decide to terminate your policy and now you're scrambling around, and I love what you said is that it doesn't cover you when it comes to an audit. If you go through an audit, and by the way, small businesses are one of the highest businesses to get audited, right? We know that. So we understand that. Why would we want to expose ourselves if we go through an audit and all of our business deductions are disallowed? That is devastating.
Yeah, imagine
So
the tax
that's a huge thing. I'm sorry?
Imagine the tax impact of that.
That's devastating. That could put someone out of business. So I love that you cover that. The other thing is, can you break down what commingling means? Because that can be, that's a really great term, but what does that really mean when I'm commingling?
So commingling means that you using your business account for your personal business expenses. So it is, I own a business and I'm out in the store, I'm buying my shoes, I'm buying my groceries, I'm buying all those different things using my business card. Now, when that happens, again, I always tell my client, whenever I talk to a client, I'm always thinking in terms of what happens in case of an audit. I'm always thinking that way because the audit is literally the 10 from number 1 to 10 is the worst thing that could happen to the business, right? So I go to, this is what could happen during an audit. So let's make sure we're doing the things correctly so that if we have an audit, the results are unchanged. So if you're using your business card to pay for your personal expenses, you're commingling funds. Because IRS doesn't tell you that the business needs to have an account in the business name. It is better to have one. What it tells you is that it needs to be separate, as in separate from what account you're using for your personal versus the account that you're using for your business. So whenever you're using one account for both, it's considered to be commingling funds. So there's no separation.
Yeah, that's really good. So let's say, for example, there is somebody who's watching this and they say, I have been commingling. I am set up as a sole proprietor. I really have one account, or maybe they have two accounts, but they are commingling, right? They don't have a true separation and they want to push the restart button. What do they need to do?
Push the restart button.
So does that mean they have to close the bank account?
No, it means then a new bank account needs to be opened that is used only for business. to receive the business income and to pay for the business expenses. So all expenses associated to that business should be connected to that bank account. All income received into the business should be to that bank account. So they can't erase what happened before, but that's what a reset button is for, right? We're gonna start from the beginning. So you start over. So if that's where you are right now, my advice to you is go open a new bank account today, get new cards for that account, connect those cards to whatever expenses that the business has, whatever bills the business pay. Connect those cards so your expenses are automatically flowing into the account, into your whatever software that you're using to track your expenses. And that way you reset, you're starting from the beginning. So it's February, it's still a little bit early. So 2025, you'll have mostly great statements, financial statements or tracking of your expenses. And going forward, you now know that commingling is not an option.
Yes, it's truly not an option. But I don't know, I don't just see this from my new business owners. I see this from seasoned people. Listen, they kind of created that habit. Maybe they weren't making money in the beginning. And so they kind of say, you know what, we can just kind of go about it this way. But once we start to have a true business where we're cash flowing, we know we have some assets to protect. We have to go into more advanced planning. So I'd love for you to break down, and you started to, but I wanted you to unpack some of the little weeds there, because sometimes we start to hear the language and it kind of goes over our head and we're not sure. And I don't want people to become a meatball and get lost in the sauce. So can you break down the entities now? What are the entity selections, and maybe a couple of things for them to think about on each one? So we know sole proprietor is for somebody who's not making any money. Let's say you have no assets, you're not making money, you're just getting started. That may work in the beginning. But remember, this is a living, thriving entity. So you don't set it and forget it. Every level we have to reevaluate. So now they're cash flowing, they have some assets. And now what should they be thinking about? Or break down the entity selections for us and help us to understand that.
Okay, so first thing, I never tell anyone to start with a sole prop. I always start with an LLC. Start with an LLC because at least you have that liability protection. And then you start cash flowing, you'll becoming profitable. You get to a point where you have $40,000 in profit. Start thinking about the next level. Start thinking about an S corp, right? Because the S corp will now bring you more tax savings. It will bring you tax savings. So it's a progression. As the business grows, your entity type may change depending on your revenue in the business, and it also depends on what your goal is for the business. So I ask clients, what is the ultimate goal for the business? Is it something that you're gonna, I'm working in this business and then I want to retire, but I'm not looking for an exit. So I may pass it on to my kids, or I may shutter the business and walk off into the sunset. What is your plan for that business? So depending on what their plan for the business is, then we start talking about at what stage you change to a different entity type. The S corp though fits most businesses from about $40,000 in profit to a really huge amount of revenue, because it has that capacity where the S corp has the liability protection of the LLC, and it has the pass-through taxation. So it is basically that sweet spot between an LLC and a C corp that business owners could use. And so I tell people, as you grow, now you start to strategize. So let's say most people, when they move to an S corp, they move to an S corp because I have profits and I'm paying self-employment taxes. And the S corp presents an opportunity where I can now be an employee of my business. So I can literally determine what my payroll is going to be. I can set my payroll at an amount that is going to, that I literally determine how much FICA taxes I'm going to pay. I'm going to pay, and then I take distributions. So distributions don't pay self-employment taxes. They're only taxed on your tax return at your tax rate. So you're avoiding taxes that you were going to pay as an LLC. So I just say you hit $40,000 in profit. Now it's time to think about going to the S corp.
Yeah, that's good. Let me ask you this, because I see this a lot too, and there's a lot of confusion about this. When they're ready to say they start their LLC, now they've got 40, 50,000 in profit. They're looking at an S corp. What do they do with that LLC? Do they keep that LLC? Do they disband it? Do they convert it? What do they do with that LLC?
So an S corp is not an entity type. It's a tax treatment election. So it means that you're still an LLC, but you're filing some paperwork directing the IRS that you are choosing to be taxed as an S corporation. So it's not a different entity being created. It is still the LLC, but the LLC is being taxed as an S corporation.
Yeah, that's a lot of confusion. I even talk to a lot of tax professionals and they don't understand the difference. So the LLC, in my mind, and help me if I'm on track with this, is a protection of our assets. It protects us from liability. But an LLC can be filed many different ways. It could be filed as a sole proprietor, or it could be filed as a sole an S corp or something, because it's not an entity. It's a disregarded entity by the IRS. So there is still the tax liability has to be addressed. Am I on track with that?
An LLC can be taxed as a single member LLC, which is a disregarded entity. I own an LLC, just me, one person. That's a disregarded entity. You would file your tax returns on Schedule C of your Form 1040, personal tax return. No business tax return is required. Now, when you elect to be, it could also be a partnership, which is when there is more than one member in the LLC. So it's a partnership. So now a partnership return is required, which is called a 1065. So you file a partnership return, and the partners of that business report the income from that partnership return on their personal tax return. On Form K1 is the form that is used to transfer your income from the partnership to your personal tax return. And then it could be an S corp. If you make the election to be taxed as an S corporation, it is still the LLC being taxed as a corporation. It is not the LLC is not, you don't have like an LLC and now I have to create another entity. It is an LLC being taxed as an S corporation. It's just a tax election.
Yeah, that's a really, really good. I love that clarification. How about this? Now we have somebody who does have a partnership. Mm-hmm. And going forward, they want to start now with a corporation. This is an objection that I hear a lot, is that if I go from an LLC to now I'm going to do a sole proprietor, an S corp. Mm-hmm. I've got a partnership. It makes things all too complicated now. Everything just gets so complicated. If I'm running an LLC and I'm doing a sole proprietor, we just can write the checks and we're done.
If you're doing an LLC and you're doing a sole proprietor?
Oh, no, I'm sorry. If you're doing an LLC and now they're ready to upgrade to an S corp, mm-hmm. right? In the past, they've been just functioning as, a partnership, and they're just writing checks to each other. They're kind of commingling stuff. A lot of times the objection is, Leah, this sounds too complicated because now we have to write checks to the business, and that it just sounds too complicated. What would you say to somebody, even if they're not a partnership, but they're an individual? In the past, they've been doing the LLC. Now they're cash flowing, and the whole process just seems so complex to them that they just say, I'm just going to stay where I am.
Okay, so I think it is always a matter of information and how the information is explained to the taxpayer. So yes, an S corp, there are certain rules that an S corp has to follow, but I look at it this way: if I'm going to save thousands of dollars on taxes, and what it requires me to do is to have separation in the business between me being an employee of the business now and me paying myself as an employee of the business, me keeping minutes of the minutes of the meetings, me having a board and all those different things. How complex is that? It is just the way it is explained. So an S corp is supposed to have board meetings, at least 2 board meetings a year. And for the people who think that this is complex, right? This is a gift to you. And I'll tell you why it's a gift to you. Because if you have to pick a board, you get to pick whomever you want to be on that board. So how about your board is your family members? So my board is my daughter, my son-in-law, and my daughter. 21, my 21-year-old daughter, my oldest daughter, and her husband. They're my board. Guess what that does? If we take a trip together, we can make that trip deductible because we're having a board retreat, we're masterminding, whatever we're doing on that trip, we focus on business activities. With our family, we're hanging out. It's tax deductible. You can pay your family members for being part of your board, which is money you may have had to give them in the first place. It's just I pay taxes on it, and because I'm helping you, right? Because we all help our family members. So if I'm helping you, which is providing you financial aid, let's call it that. I'm providing you financial aid.
Yeah.
I'll get a tax deduction for that. But if you're on my board, it is payment for being on my board, and it's a deduction. So with all things, it is weighing the pros and the cons. I think that a lot of people are, well, my CPA told me that this is complicated. I have to follow all these rules. So case study. I have a friend who is a contractor. He is an LLC. He makes like $5 million a year, but he is an LLC. And it doesn't matter what I say to him. He goes back to his CPA, and his CPA tells him something else, and he stays with his CPA because he's been with that CPA for like 20 years. He's like, I've been with this guy for 20 years. He will not steer me wrong. And I'm like, okay, but I can show you how being an LLC is costing you thousands, maybe hundreds of thousands of dollars every year. So he says his CPA tells him that it is too complicated. He has to have board meetings. He has to he's now an employee and all these different things. But when does it become again too painful to be one rather than the other? And that is always my question. And that is something I will always go to. When does it become too painful to be an LLC versus being an S corporation? When does having a board meeting or having 2 board meetings become an acceptable hassle if I'm going to save thousands of dollars on taxes? And these are the questions that you need to ask yourself. So when your CPA or your tax professional tells you that an S corp is too complicated, have them break down for you what they call complicated. What do they consider to be complicated? Walk me through step by step the things that I need to do as an S corporation. And now walk me through the savings that I stand to gain as an S corp versus being an LLC. And mark my words, they're not going to be willing to do that for you. Because at the end of the day, if you're to the point where you're making millions and you're still an LLC, it means that you should be an S corp because you would be you'll be saving taxes, and they do not want you to see how much they've been costing you over the years. So when you ask these questions and they refuse to do these things for you, you know for a fact that you now need to go find yourself another tax professional. Because this tax professional is not working for you, they're working for the IRS.
Yeah, that's really, really good. That is so true. I love it. I love it. Listen, this is a real conversation. You didn't come here for rainbows and butterflies. You came here because you want to know the real deal, and this is a real deal. And I want to greet one of my amazing friends, Miss Chris Montessori, the Ability Ambassador. You know, he's an advocate to save teen lives. His story is incredible. And if you have known anyone who's been sort of a victim of distracted driving, I have a personal story about that. He's really an advocate to really educate our teens and open those conversations so that we can save more teens' lives. And at the end of the day, it saves more lives. And really, I love this. So I think what I'm getting is that, number one, we need to have an analysis, right? If we're doing a sole proprietor right now, we need to have an analysis to decide what is the true thing that I should be using going forward. What are my options? And number two, I would ask, what is it costing me? So for example, we've been talking about a lot of concepts here, but what is a self-employment tax, Miss Chris? If somebody's making $100,000 and they're filing it as an LLC, they just don't understand the difference. How much is that costing them? What is that self-employment tax that they're being imposed on them?
So they're paying 15.3%, and then on the net profit, and then everything that goes onto the 1040, they're paying taxes on that at their tax rate. So straight off your net profit, you're paying 15.3%.
Yeah. And somebody who's making $100,000, folks, that's over 15 grand, right?
Mm-hmm.
That's a lot of money.
How an S Corp makes a difference is you become an employee, and now you determine what your payroll is going to be. And then your distributions, there's no self-employment tax on your distributions, which means that that net profit line that goes on the K1 that you report on your tax return, there's no 15.3% on that distribution. You pay taxes on your tax bracket on the 1040, but there's no 15.3% on that. So you're saving that 15.3% upfront.
Yeah, that's huge. That's why I say it's about playing chess. We need to start strategizing. And if your tax professional isn't willing to do that for you, please reach out to Miss Chris. Listen, she is the expert. Her knowledge, not just her knowledge, but her strategies, right? She looks at your business holistically and proactively so that we can implement the strategies going forward, because it's not just about today, but what do you plan to do with this business? Are you going to create a partnership? Are you going to sell it? Are you going to train somebody to rise up to take it over? Are you going to gift it to somebody? I had somebody who actually did that. Are you going to franchise? Like, what is your planning for this business? And what do we need to put in place, not just for now, but in the future? As you grow, you expand, you need more employees, you're going to scale, you're opening up other options, right? You have other facilities that you're opening up. Are you working only in your state? There's a lot of questions that need to be answered, but that really creates the conversation, and it requires somebody to have a specialist who's going to take the time. That expert's really going to take the time with you and customize a solution for you. These are not cookie cutter, one size fits all, right? These are customized solution that it requires you to sit down with a professional and really go through the entire analysis, and then we can start to put those strategies together. So anything else you want to say in closing, Ms. Chris?
So I'll say that if you're working with someone and their only goal is one, at the end of what happened this month, here's your financial statement, there's no strategy involved, you need to work with someone else. If you're working with a tax strategist and their only focus is taxes, but they're not thinking about the other pieces that come together for wealth, you need a new tax professional, because tax doesn't exist in a silo. Wealth doesn't exist in a silo. It needs to be integrated. And unless you have a tax professional that's looking at your holistic picture, you can never get the best possible outcome. So whenever you're choosing a tax professional, you ask yourself, is this person really going to be that quarterback for my team? Is this person going to, well, if you don't have a team, is this person going to help me to build a team, as in introduce me to the people that I need to support me in the different areas? So that's how you choose a tax professional.
Absolutely. I love it. I love it. I love it. Great golden nuggets. We appreciate you, Ms. Cardy, and all your expertise and knowledge and wisdom. And, we're going to be here every Tuesday for Tax Tips Tuesday. Listen, bring your questions. If you are going through something and you have a question, you can send it to me. We can do it anonymously, or you can even join us live. Type it in the chat. Even if you're watching, if you're on Team Replay, go ahead and send us a DM. We're happy to help you, because at the end of the day, it's really about bringing that value to you and helping you to educate through the process and keep more of your hard-earned money. So that's going to do it for this edition. Thank you, all of you. I love you, Team Replay. And wherever you're tuning in from us, let us know where you are. And Mr. Chris, we would love to have you check in here and put where you're from. I know where you're from, but go ahead and put where you're from in the comments, and you're on Team Live. We appreciate you, everybody. Thank you so much. And we'll see you soon. We'll see you at the top. This is your year to thrive in 2025.